This is not financial advice. Just saying, I've only been investing for 1 year, so I'd call myself a beginner, and I don't want anyone to take this as financial advice. This channel is practically just a way of documenting my own investing journey, whilst also being completely transparent on everything I buy, if I ever decide to sell anything, and my theses on why I am buying that specific stock. Now, everything you see on screen here is real. It is real money that I have invested. I have it invested on Trading 212. It is an investment platform. No, I do not trade. I invest over a long term with a minimum of 5 years, but I project out 10 to 20 years into the future. Any company I buy, I do not plan to sell within the next year, 2 years, 3 years, or ideally even 5 to 10 to 20. These are companies I want to hold for literally the rest of my life and let them compound over time. And yes, it is all real money. This is not fake money. Every single pound here I have deposited, and I do on a consistent basis. Over the last 1 year, we are up 33.7%. I started on December 9th, 2024. It is currently January the 5th, 2026. So in a year and just under a month, we are up 38.5%. My internal plan is to target 15% year-over-year growth. Last year just blew that out of the window, mainly because of Google. They had a huge run-up after their fears of ChatGPT taking over Google search kind of died down. They also beat the DOJ case, where they may have had to sell off Chrome, and there were a bunch of other catalysts along the way as well that push the stock up. But as for each individual company, I will probably go through these individually in their own separate videos, but I could also just group these three into a single video. I haven't planned that far ahead yet. Right now, it's just about the general thesis and my approach to investing, my views. I'm not a day trader. I do not buy with the intent to sell next week, next month, or even next year, not even the next 2 years or 3 years. This is long-term investing, not day trading. What kind of companies do I buy? Well, they are called compounding machines. And compounding machines are high quality companies that grow free cash flow per share steadily and predictably over time. Now, what is free cash flow per share? So we have a company like Microsoft, right? I'm pretty sure everyone here knows Microsoft. They've got Microsoft Azure. They've got the Microsoft suite of software. That's Word, Excel, PowerPoint, and all that. Just the whole Microsoft 365 kind of ecosystem. And if you look at their revenue by segment, you have productivity and business processes, intelligent cloud, and then personal computing. But the main thing I look at in companies is their free cash flow. To calculate the free cash flow of a company, you take their net cash, you subtract capex, which is capital expenditures. That can be anything from buying the GPUs to data centers, to buying the tables for their employees, buying new cars for new Waymo robo-taxis as Google would do. Any long-term assets such as buildings, equipment, vehicles, this is all capex. This does not include paying for employees or research and development into a company. Anything that is a long-term asset like buildings or equipment or tools or vehicles, that is all capex. As you can see, Microsoft has had very stable free cash flow growth since 2009, 2010. But if we switch it to quarterly trailing 12 month, it smooths it out because this is the trailing 12 months. This is the last 12 months of free cash flow. So those significant dips just get removed as it kind of averages it out to see it in a more smooth way. Free cash flow is actually a very good way to look into the inside of a company to see how much they are spending on like investments into capex and just how much they are reinvesting into themselves. As if they weren't going to spend a lot of money reinvesting into themselves and just making huge profit, then their free cash flow would spike up. But instead, if they use that profit to spend it into themselves, their free cash flow will go negative, or well, not negative necessarily, but just down. And you can see that during 2022 with Amazon, where it spiked, where it went from 24 billion trailing 12 months all the way down to minus 30 billion, as they spent a lot of money investing into Amazon AWS, which is their data centers, like their cloud hosting. Majority of the internet is hosted on Amazon AWS. They saw huge potential gains in that, so Amazon went out and built out huge data centers, which made their free cash flow negative for a bit. And you can see that in their expenses. If I go to their expenses and just cut out everything else, sales and marketing, general and administration, and research and development, and just leave capex, you can see that in 2020 they spent $24 billion on capex, and then we go up to Q2 2022, it's all the way up to 65 billion. So that's where that huge spending came in. They spent way more, making their free cash flow shoot down a lot. And of course, right now with the AI boom, it is through the roof because they believe that investing huge amounts into warehouses and data centers for AWS, and once again, like I said, warehouses for their Amazon delivery services and everything is going to pay off large amounts in the future. It's going to be able to raise margins, make them more profitable, reduce employees, improve efficiencies within the company. So they have gone full force ahead in the capex spending. It has spiked through the roof, over $100 billion up to $120 billion. And you can see that in their free cash flow, spiking down all the way to 10 billion from 48 billion. They also have a large amount of cash that they're sitting on, being at 94 billion cash with 50 billion in debt. The reason they don't pay off the debt is that it's more likely that that cash is able to make them more money than the interest rate of the debt is increasing in size each quarter, year, whatever interest rate that debt is set at. So why does free cash flow even matter in the first place? Well, being able to track the free cash flow of a company can really show you how that company is doing, how it's growing. You really get to see how much money moved into the company, how much money moved out of the company, where they're putting that money, how much money they have left over after their expenses to return to the shareholder. Are they reinvesting that? Then you can justify yourself whether you believe that reinvestment is worth it or not, whether you believe that reinvestment is going to give a good return in the future or not. But just the free cash flow alone isn't enough. You need to account for stock-based compensation. Now, stock-based compensation is the company issuing shares of that stock to employees instead of giving them cash. So instead of a company saying, here, this is your bonus for the year, we're going to give you $5,000 in cash. Instead, they will just give you, that would be a total of 18.4 shares. So instead of them giving you 5,000 cash, they will just give you 18.4 shares of Apple. This increases the share count, the outstanding shares, which you can see this is Apple's outstanding shares over the last 31 years. It would increase the share count, making your share less valuable. So issuing shares to employees of the company is bad. It's bad. It's good for the employee. It's bad for the shareholder. There are more shares in the market. Ideally, you want stock-based compensation to be low, and also you want the free cash flow to grow faster than the stock-based compensation is growing. That is one problem with Meta currently. Meta has amazing free cash flow when you look at it on the charts. If you just remove the stock-based compensation and go all time, like that is amazing. That is incredible growth. 24.5% year over year over the last 10 years is insane growth. But when you enable stock-based compensation, it is currently eating just under half of their entire free cash flow. So even though they made $44.84 billion over the trailing 12 months of free cash flow, after you adjust it for stock-based compensation, it's down to 26. So that's something to keep in mind at all times. It's obviously really good if the free cash flow per share can grow way faster than the stock-based compensation can. A good example of that is Netflix, where you can see their stock-based compensation has actually decreased, whilst their free cash flow has increased substantially. The reason that they were able to issue shares to their employees, this is back on Apple here, 12 billion trailing 12 months, like all the time. It's slowly growing, but not as fast as their free cash flow is growing. This is growing way faster than that down there is growing. The reason that their share count isn't going up and it's still going down is because Apple generates so much free cash, being pretty much 100 billion every year, trailing 12 months, that they can spend so much of that cash to rebuy their own stock. So Apple will be pretty much on the daily rebuying their own stock, which is making that share count go down drastically. It has gone down 4.07% year over year, every single year for the last 10 years. That means your stock performance, if you hold Apple is buying so many shares that your share price is going up 4% every single year because they're buying so much of their own stock. That is them returning money to the shareholder in form of share buybacks. It is the exact same thing as a dividend. People love to use dividends as a way of tracking money returned to shareholder. A good example of that would be MasterCard. They have beautiful beautiful, beautiful smooth dividend growth, and people love this as it's very clear, very simple. You know that for every stock you hold, for every share that you hold of MasterCard, they will pay you $3.15 quarterly on that share. And then you can also see that it is growing at 16.74% over the last 10 years, year over year. It is very clear, very easy. You hold the shares, they pay you directly, and then you can choose what you want to do with that money. A lot of people decide to reinvest that dividend, so they get paid, say, $100 worth of dividends. They'll just buy more, they'll just put it back into MasterCard. That is literally just a share buyback. Instead, the company just does it for you. You don't do it yourself. What you are doing right there when they pay you a dividend and buying back the stock, again, is just a share buyback. They are instead just buying the stock for you, and your value of the stock is going up. So that was a little yap session, but free cash flow is one of the main metrics I look at. It's not the only metric. You kind of have to look at the grand scheme of things. It's just one of the main things I look at for true growth of the company, like the internal side of the company, how much cash they are actually producing. Either way, moving on from just a little yappage about free cash flow there. A compounding machine is just not based all on free cash flow per share. There's a lot that of other things that go into the companies. I like to make sure that they are a monopoly. I like to make sure that they have large market share in a concentrated industry, making sure that they can't just be replaced. You know, there's not much competition for them. There may be some form of competition, but they kind of hold their ground really well where they are. Something like ASML would be the perfect example of that. They make lithography machines, and these lithography machines are the ones that print out the patterns on wafers for chips. But if you ever look deeply into how complicated these machines are, ASML holds practically all market share for lithography machines, and they are so incredibly advanced that no company nowadays in the world can make what they make with such high consistency and such low failure rates that they pretty much make every single chip in the world. So the food chain of the chips kind of go ASML, and there's ASML, there's Applied Materials, and there's KLAC. I don't know what KLAC is actually called. I just know it's ticker symbol. KLA Corporation. And then there's Applied Materials, which is that. And there's a few more other companies. These are the companies that make the machines to make the chips. Then you have TSMC, which buys those machines from ASML and Applied Materials and KLAC. And TSMC has the warehouses in Taiwan that actually produces these chips for companies like Nvidia and AMD and Intel. And that's practically the major companies. And you have like Samsung and all these other smaller ones. But of course, Nvidia, AMD, and Intel are the main three. That is part of the reason I choose ASML. They are basically at the top of the food chain. Without ASML, you can't make the chips. You just can't make the chips, at least to the complexity that they are now. When they're going, when ASML has now the high NA machines. High NA stands for High Numerical Aperture Extreme Ultraviolet. But they basically hold a 100% monopoly for that type of device. If you want high-end, top-of-the-line 2 nanometer nodes for chips, ASML is your only answer, and they're the only ones who can make the machines that can actually make it. For any company to catch up, they would have to spend probably 10 or so years just dumping into research and development to learn how to get up to to ASML's current stage. But within those 10 years, ASML is going to be 10 years ahead of them. So they just hold an absolute monopoly, and that is their main moat going for them. The only competition they have is China trying to also make the machines that they make, which is a threat. But that would be a whole nother video to go into. A video specific to ASML, as that's a lot more in depth than we would have time to go through today. So yes, monopolies, large market share concentrated into something specific. Good distribution is also amazing. If they're worldwide companies, you could get a Google. Google is a worldwide company. They operate pretty much everywhere. Maybe not Russia. I think YouTube is banned in Russia. Of course, China, YouTube is also banned. But the more worldwide it is, the more diversified it is. If something tragic happens in America, they still have like the rest of the world that they are gaining income from. They're not just solely based in America. They may be an American company, but they don't generate revenue only from America. Good example would be Netflix. Sure, Netflix is huge in America, but it's only half of their entire revenue. Even a little bit under half. It's not just half, it's a little bit under half. So as much as these are American-based companies, and you could say, is it risky to be invested in only American companies? The absolute scale of these companies is worldwide. It's not just an American company. This is popular across the entire world. And that allows it to be a lot less risky. As for the whole company to collapse, it would have to be more than just a singular country. Of course, when America is half of it though, America does truly mean a lot to the company in terms of their revenue, but it's not everything. And then last of all, high barrier to entry. That was the ASML thing. A lot of these monopolistic companies like Amazon, Google, Meta are very hard to, overtake. The barrier to entry is just insane. If you wanted to replicate Amazon AWS or their first-party online sales and third-party selling services, basically just their delivery services, to get to their level of logistics and efficiencies to be able to have 1-day delivery or even same-day delivery across such a huge country, no small company can come along and do that on such a big scale. You need insane amounts of time and money invested into it to be able to reach that scale. So these companies are really grounded within society and are basically just not going to go anywhere, at least over the next 10-20 years. And that's one of the reasons I choose these companies, these big, huge monopoly companies, because I believe that they are a lot more predictable down 10 years from now, down 20 years from now, than something like a small shot bet like, say, Rocket Lab, which is a much smaller company at only a $38 billion market cap. I don't know too much about Rocket Lab, but they are similar to SpaceX in the way they are trying to make reusable rockets to make getting things into space cheaper. But when I see a free cash flow of only negative and net income negative and EBITDA negative and earnings per share negative, and their profit margin is negative by minus 64%, I just can't reasonably predict 20 years from now whether they are going to still be around compared to something like Google or Amazon or Meta. I believe these companies will still be around. They are just simply too ingrained within society that they will most likely, this is not guaranteed, it is most likely still be around at that time and most likely be bigger than they are now 10 years from now. So, what else to compounding machines? We have pricing power. Pricing power is the ability to push up prices. So something like FICO. Now, FICO is a company that is mainly popular in the US as they give you credit scores. Now, credit scores are huge in the US. It's a way for banks to understand how people can manage their income. They use your credit score to base to give you loans and base what interest rate on that loan they give you. So in general, credit scores are really important to every single human in the US. If you are watching this and you're from the US or in a country that has credit scores, you probably know how important keeping a good credit score is for your future, for the ability to take out loans at low interest rates, for housing, for mortgages, for almost anything to do with borrowing money. And FICO is one of the main companies that give you a credit score. And because they are so dominant in it, and they are, banks are so reliant on them, on having to pay them to give you the credit, to give the bank your credit score, because FICO charges a fee on giving a credit score every time they request a credit score for a person. And it's something that the bank just needs. They can't not need it. They simply just need it. It's a necessity for them. They have huge pricing power, and they can increase prices for each credit score that they are giving, and the bank can't do anything about it. They have to pay for it. They just have to pay for it. And because of that, they are able to increase their profit margins drastically. If we go over the last 10 years, you can see it is just rising, 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 and rising. It started 10 years ago, it was at 11.18%, and as of most recent quarter, it was at 30%, with the one before that being 33%. Now, a less aggressive version of that is something like Netflix, where they have done price increases and people have complained about price increases for the longest time. But at the end of the day, as much as people may boycott it and say, I'm canceling my Netflix subscription this month, Netflix will still just produce a new show, a new banger that people want to watch. Say, Stranger Things, K-pop Demon Hunters, Squid Game, all these top of the line, they just explode, go worldwide shows. And the numbers don't lie. You can see their total subscribers here. People can boycott it how much they want, but at the end of the day, most people come back, if not more people come to it, as much as they increase prices. Now, they can't do it as aggressive as FICO could do. They couldn't just double it next month. That would lose a huge amount of people. But if they slowly increase it over time, most of the time people will be like, oh, okay, it is what it is. $11 to $12. It's just an extra dollar. They're still gonna end up paying for it. Of course, pirating exists, but people pay for convenience. Not everyone knows how to pirate, and once again, the numbers don't lie here. They have done their price increases, yet subscribers are still growing. That is pricing power. When you can increase prices, customers won't leave. They will still stay with your product because it is just simply too good. So next is operating leverage. Operating leverage is the company being able to grow its own product and volume internally, just organically within itself, without requiring acquisitions of other companies. They don't have to buy other companies to grow their own company, their own viewership, their own sales. That would be like YouTube having to buy, if YouTube wasn't growing anymore and it was fully flat, and then they bought out Netflix, so then they could have YouTube and Netflix together, and that is their only way of growth, by buying Netflix. That would be bad. You want the company being able to grow on its own, and if acquiring another company was beneficial for it, then go ahead. That is shown in Netflix right now, literally, because Netflix has a deal to buy Warner Bros. Discovery, which comes with HBO, and HBO has a huge amount of IP. They have Game of Thrones, they have The Last of Us, they have The Sopranos, they have the DC universe, they have The Lords of the Ring. They have all this incredible IP, and Netflix believes, even though they don't usually acquire much, they don't usually buy out other companies, they believe that having all of this to them would be super beneficial, as Netflix has 300 million subscribers as of Q4 2024. Warner Bros. Has roughly, HBO has roughly 100 million subscribers. So Netflix is going to be able to take all this content for themselves and push it onto Netflix itself. They could decide, so HBO also has June. They could decide that, for this weekend or for this month, we want to put June onto Netflix. And they can now show that to 300 million people and potentially get even more people onto Netflix, with people now knowing that June is on Netflix. Or, if they put the Game of Thrones on Netflix for a weekend, there will be a lot of people who will move over to Netflix because Game of Thrones is now on Netflix and they wanted to watch it. It'll also get a lot of people who are already on Netflix interested in it because they're like, oh, I already have Netflix, I'll watch June. And it just increases the whole portfolio of what Netflix has to offer, which is good. But either way, alongside that, Netflix has already shown it can grow naturally on its own. It does not require the Warner Bros. Discovery acquisition to go through. If it doesn't go through, it's not the end of the world for the company. They can still just grow naturally as they have already been. They'll just continue doing what they're doing. That acquisition would just be beneficial for it if they can get access to all that, all that IP. But alongside operating leverage is also operating leverage itself, just being able to operate within the company and push up profits without having to spend more. This is shown once again in Netflix, where if you see since 2021, their content budget, which is how much they spend on creating content, is practically flat. It went up, then it went down, and it's practically just flat. So we can average this out to about 16 billion over the last 4 years, 3 years, since it's only January, 3 years. But with their content budget being flat, well, growing, let's just take the 5 year, growing 5.84% over the last 5 years, year over year. So that's 5.84% every year for 5 years. It has only grown by 5.84%. But if you go to their revenue over the last 5 years grew by 12.74%, so over double. They've increased their spending by only 5% year over year every single year over the last 5 years, but their revenue has increased by 12%. That is operating leverage. That is being able to increase spending by only a little bit, yet revenue going up much more, over double what they are investing into themselves. Okay, and the last part of compounding machines, which is kind of a kind of gray area nowadays because of this AI boom. But ideally, you want companies to be capital light, use their cash that they have very, very, very well, because you can see, in companies' financials exactly what, not exactly, but generally what they are using their cash on. If we go to something like Visa, MasterCard, almost identical companies, they do very similar things. They're a duopoly, but Visa doesn't have to spend really much money. They don't have to advertise. They don't build out warehouses. All they do is issue cards and charge a little fee on every transaction. So a company like this is extremely capital efficient. They can, they're making 40 billion revenue over the last trailing 12 months, and 21 of that, half of their total revenue became free cash flow. Half of it. Their expenses come down to only what is that, like 5 billion? So out of the 40 billion they made, 5 billion went into expenses, and then the rest of it will just get returned because they have so much excess free cash flow. They have so much extra money that they just return it to the shareholder. They returned $22 billion to the shareholder in the trailing 12 months. Because at the end of the day, a business is just made to make money. A business is made to make money. And when they have so much money, they make so much money, they can return all that back to the investors who invest in that company. And that is shown in something like Visa, where they make so much money, they don't have to spend any. They barely spend anything because, they don't have to be building out huge warehouses or anything. So they can be super efficient with their money and just return it back to the investors. Once again, it's a little bit weird nowadays because the AI boom is making it so there is extremely big capex spend, 77 billion as of last quarter in the last trailing 12 months for Google. Whether you believe that is going to give a positive return for the company, whether you believe that investment into AI data centers is going to become profitable for the company, that's your own opinion. But yes, as much as they are spending a lot of money into capex, if it does not end up being profitable, they can just cut it. They can just cut that money. This is all real money that they have made, and that they are reinvesting into themselves. If it doesn't end up turning profitable, they can just stop it. They can just go back to being at 28 billion instead of 70, which will make their free cash flow absolutely skyrocket and, blast over 100 billion, as they would be now saving like 40 extra billion dollars. Anyways, that was a lot of talking. I don't know if that came across clearly. This is my first video doing this. I definitely have a lot to refine when it comes to this. This is a general just investment thesis on how I approach investing, how I view companies, what I look for when I look into a company, and what my mindset is going into investing. There is a lot more I can get into, especially when it gets into company specifics. This is just a broad general thesis. Each company has its own specific thesis into why I believe it will perform well over the next 10 years, and that would require a separate video for each one of those companies. I am looking at doing Netflix and MasterCard as one of the first ones Hopefully this will be a weekly schedule. There isn't an exact schedule I will stick to. It will more just be when I feel it is right to make a video, or I have something specific I want to talk about, I will make a video on it. If there's any huge market event that sends the market down 10%, sends it up 10%, whatever the hell, I will probably cover that. But yeah, $49,000 at the time of recording this. By the end of 2026, I would hope to be at 100,000. Anyways, I hope you enjoyed this video. I hope it was somewhat beneficial. Maybe it gave you a little bit of perspective into exactly how I approach investing. And yeah, have a good day.